So once again, welcome you all to the intervention section and revision day 2, the first lecture video. We are going to look at capital reduction, everything about capital reduction concerning your paper. Like we said, it's 50-50, not too high chance of coming, not too low chance of not coming too. So 50-50, good. So that is it. Now we'll go straight to the game. For capital reduction, in summary, we said that it's normally a strategy designed by a failing company to revive or turn around his business. That is all about capital reduction. Good. Okay. Great. So capital reduction, in summary, is a strategy taken by the organization that are in struggling mood or making consistent losses. That is what we refer to as like you are reducing your capital base or revitalizing your capital base or reviving your capital base. So that is a capital reduction. So let's look at some few points in here. So capital reduction. So that is capital reduction. Good. Now with the capital reduction, we say capital reduction or business reconstruction. Another name is for business reconstruction. So business reconstruction. Now, a struggling company have two options. Struggling company have two options. Any company that is struggling in business, making consistent loss to the extent that your income surplus is negative. Wow. Your income surplus is what? Negative. That is, you make consistent losses to the extent that your retained earnings has accumulated a negative figure. That is, such organization need turnaround strategy. And that strategy is you have to go through business reconstruction process. Such company have two options. Options available to the company who is failing, who is struggling. The first option is to liquidate the business, further to liquidation. That's option one. The first strategy available to you is further sell all the assets, pay everybody that you owe, and move from the system to avoid accumulation of what? Loss. With the current negative 1,000, it's far better than waiting for 5 years to come, hoping that you can probably turn things around, but rather things are rather turning you around. And now it has increased to 50,000 today's loss. And guess not again, it will double in next year. So what do? Shut down the business. Now, sometimes liquidation is not present situation. No, it's not good at all. Liquidation. Sometimes liquidation is not good. What makes it not good? Because imagine that business that you have struggled on it, started it 20 years ago, and just within few days, it's going to cease to operate. All the good name, director one, MD one, CEO one that they've given you in that company is going to like vanish. So sometimes liquidation is not a present situation. So there must be a second strategy. The second strategy is what? Now you have to reconstruct the business. So reconstruction. Reconstruction. You have to reconstruct the business. Then to save, so-called a turnaround or revival. That will be the revival or the turnaround strategy. So now it means that we should understand how to assess the company, how to determine the company's position in an event of what? Liquidation. And we should know how to deal with reconstruction. Good. For the reconstruction, there are two types, internal and external. We are interested in the internal because we are accountants. We are interested in the internal. The finance managers, they are interested in what the external reconstruction involving third parties, including mergers and acquisition. If you are struggling, you can emerge with a good company to at least save you from falling. Good. So that is the external strategies, but we are going to look at the internal strategy using accounting methods. Good. Now, reconstruction for the purpose of the examination, we will meet two. We need a scheme. So first, they'll ask you to prepare a financial position with a given scheme, with a given scheme, with a given scheme. That means there must be a scheme. There must be a proposal. There must be a formal structure on how the business must be revived. Systematic procedure, formal, well communicated, well documented, that please use, sign and sacrifice this amount, sign and then give her this amount. Good. So that is it. Or they will ask you to design a scheme. So designing of a scheme. So now we will ask you to design a scheme in which you have 6 solid steps, 6 standard steps in designing the scheme. Then you are done. So it means that we have to make sure that we have a fair idea about 3: liquidation, financial position when the scheme is given, and designing the scheme. If you're able to know these 3, that's all about your capital reduction. If indeed capital reduction will visit us, it's one of these 3 that will appear, and then you are what? Free. Now let me explain this. On what basis do you select liquidation and reconstruction? You compare losses. Let's assume that if you liquidate, the entire loss that is likely to be incurred will be maybe 600. And then the loss per reconstruction, let's assume that that one too is also what? 400. So the question is, will you liquidate or you reconstruct? So if you have 600, if you should liquidate right now, putting all the losses together, everybody together will lose 600,000 cedis. But if you should do reconstruction, at least beg some of the stakeholders and then cancel some of their investment with us, at least we will lose what? 400 Ghana cedis. So the question is, then which of these 2 strategies is good or is cheaper in terms of losses? So that is it. So it means that over here, reconstruction is what? Cheaper, because the loss per reconstruction is 400, which is far, far, far better than loss of what? 600 upon liquidation. Likewise, if the loss of liquidation is also 500 and reconstruction loss is what? 800, we should liquidate. Because liquidating offer the better position than to reconstruct. That is the basis which you use to select whether you should liquidate the business or do the reconstruction. We are done. So that is it. So today, our main aim is to know how to do liquidation, know how to prepare financial position with a given scheme. Then finally, we should know how to design a scheme using the 6 standard steps. The 6 standard steps. That's all. Good. So we will start. Just that liquidation is in the design of the scheme. So I'll do that when I'm doing the design of the scheme. So we'll not do it on its own and still come and do it under the scheme designing. So you wait when I'm doing the scheme designing, I'll do liquidation. So it means that 11 takes 2. So I have reduced the topic into 2. When they've given you a scheme. They've given you a scheme for you to prepare financial position, or you are designing a scheme. So we will start with how to prepare financial position with a given scheme. Then when we are done, we will now look for how to design a scheme. So in this question, the examiner will give you a scheme or proposal, a formal scheme or a formal structure that you have to use to prepare the financial statement. Usually, that particular question is a bit cheaper than you are designing the scheme, because the scheme has 6 steps. The workings over here is not even up to 6. Basically, maximum of 5 plus the balance sheet. Good. So you should take note. Now, I have to give you the trend. I have to give you the trend on this particular topic. Each and every topic that you do, you should get a trend. Design of the scheme have dropped 3 consecutive times. 3 consecutive times. And then last sitting. Then this very one has dropped just once. Just once. So that's the trend. And then all the 3 consecutive sittings where design of the scheme was common or was dropping, it was moving in a similar direction. In fact, the last sitting and last 2 sittings on, for that one, there was the same question that was repeated. So it tells you that the design of the scheme is a very topical issue. But we look at the how to prepare a financial statement with a given scheme. Then we are done. So let's kickstart the game. You will like the game today. Now, when they give you a scheme and they ask you to prepare the financial position, there are some 3 to 4 workings that you don't need to joke with. Whether the examiner asks you or not, you have to prepare them. Some of the examiners will ask you specifically to do those workings for them. But it's good that you know them already. Whether they ask you or not, you need to prepare them. Without them, you cannot probably prepare the financial position well. Even though you can prepare the financial position, but it will not be well without them. So first, items or the workings that you need before you can prepare a financial statement, when they have given you what? The scheme. The scheme simple means formal plan on how we should revive the business. Who should lose? Who should bring money? Who should sacrifice? Good. What assets should we sell? Should we go and buy a new asset to replace all our aging plant? So, item number one that you have to, or account that you have to open when they have given you the scheme. Number one is capital reduction account. We call it capital reduction account. It's a self-balancing account which cater for all losses and gains that will arrive as a result of the scheme. So as a result of the scheme, if you get any gain or loss, it must move to the capital reduction account. It's a T account like this. Yes. Now, we should just throw the debit and credit away and still go by left and right, add and subtract. Here, all losses are to the left side. So all losses. So all losses are recorded here. All gains are the right side. So all gains. Yes, in capital reduction, the company might gain, the company might also make some sacrifices. What are the examples of losses and then the gains? Let's look at the gains first. Number one, gains coming from assets as a result of what? Revaluation. Gains coming from where? Assets as a result of what? Revaluation. One of the rules suggests that in preparing capital reduction, you have to what? Revalue all your assets so that it will reflect the current values in the books. So if you do the revaluation, two things, either you're going to lose or you're going to gain. And all the gains will be here. Gains number two will be gains coming from the stated capital. Stated capital. Any sacrifices made by the shareholders, it means ordinary shares or preference shareholders. Any sacrifices. Okay, so ordinary shareholders, their value was 3,000. You have consulted them, and then they have to strike off 1,000 series of their investment away. So they've scrapped off 1,000 series. So that 1,000 series is a gain to the company. But the gain will not recognize the value of 3,000 any longer. They will reflect 2,000. So the company is gaining. So immediately, I record the gain at where? Capital reduction account. At what side? Gains. At the right side or the credit side. Then you are done. All gains. Then number three, can also get a gain from liabilities. Gains from where? Liabilities. Maybe you owe a creditor. That's the discount received. You owe a creditor about 2,000 cedis, and you wrote to the creditor that, Mr. Man, we are in difficult times. So kindly help us revive our business. We have proposed to cancel 30% of the amount and pay the remaining balance to you immediately. If you do agree, sign and then provide the support. If you don't agree, let us know. Good. It is not by force, it's proposal. You have to agree. So let's assume that the creditors have agreed that, okay, strike off 20% instead of the 30. 30 is too much. If they cancel 20% because it is what? Negotiable. So cancel 20%. So that 20% of the debt, which is 400, it's a gain to the company, but a loss to who? The debt holders. Good. So it must come here. Any gain coming from where? The liability. Sometimes too, you can also decide to convert their debt, especially debentures. We have 15% debenture. You can convert it to what? To that of ordinary shares. Why do you do that? You do that because the company is struggling. The 15% debentures, debenture, they are entitled to a fixed interest. Ordinary shares are not entitled to fixed dividend. So even if we are not doing well, we can still hold on with what? Ordinary dividend. But with the debenture interest, you can't tell them that business is not going on well. You must also always pay the interest. So that's why in capital reduction, you see us converting a lot of debt into ordinary shares because we are running away from the fixed repayment. Something that will take money from us regularly. If you are doing reconstruction, you should stop items, instrument that will take money from you regularly. No, stop. When the business is in a good shape, sound shape, that one day you can pay regularly. But when the business is in a difficult times and then you have instrument that every month takes money from your account, no. It's like, have you seen why when COVID came, most of the interest bearing assets were seized. Most of the interests were seized. Most of the sanctions, penalties were released. Yes. But in difficult times, those ones must be released. So that's why we have to convert. And in converting, maybe the debt was 300. It's okay, don't worry. Come and take 200 ordinary shares instead of the 300. So the company will gain by what? 100. We are using 200 to pay something costing us what? 300. So by always, the company will gain. So I write it here. The venture, the company will gain. So that's the losses. So the gains coming from where? Liability. Okay. Then let's continue the game. So these are the examples of gains that you may likely to have them. Then let's go to losses. There are many. Number one, losses coming from assets. That's revaluation loss. Losses coming from where? Assets. Losses coming from assets. Losses coming from assets. Yes, if you do valuation and it happen that the value decreases, you've made a loss. So it must be here at the capital reduction account. That's all. Number two, the income surplus. Income surplus. That one, please, whether the examiner inform you or not, kindly bring it. Cancel the income surplus, especially if it have a negative balance. The income surplus in the book, it will be always be negative, maybe 3,000 negative, suggesting that the business in what? Difficult times. And if you're in difficult times, you have made consistent losses and want to revive the business, in the new business, you have to wear white too. In the new business, wear white, no dot dot. So any losses must be cancelled or delayed from the book. You have to move it. So income surplus. Once you see that it's negative, it's a symbol that suggests that the company is what? In a struggling period. So that one, whether the examiner inform you or not, please cancel it from the book by bringing it here. Then number three, we have what you call bad debt and provision for bad debt. Provision for bad debt. This losses on what? Trade receivable. Agreed. Losses on trade receivable. Maybe one customer, as now that we are doing the capital reduction, they've informed us that that customer has been declared bankrupt. We can't trace the money that that customer owes us. So what do? Let's write it off. So we write it off and then we come and put it here as a what? As a loss to the company. Good. Then item number 4, inventory written down. Inventory written down. If we want to move on and wear white, then we have to cancel some issues out though. We have to like take all the goods that are not in good shape out, clean everything, usher them, and then let's see. So they also lost. Inventory written down. Inventory written down. Then last one that I'll tell you, or I'll give it to you, will be reorganization expenses. Reorganization expenses. Reorganization expenses. Reorganization expenses. So these are basically the items that will go into the capital reduction account. Please, it is not compulsory or by force for you to have all these items in one question or not at all. If it is there, you bring. If it's not, then you move on. Or they can even create additional ones that they are not here. But the principle says that anytime that the company will make a loss, incur a loss, it must come here. Gain, bring it here. You are done. When you are done with the game, then you balance the game. Yes, balance the account nicely. Although it's a self-balancing account, if you are going to balance it, leave a space and balance it. Ideally, it should be a self-balancing. Self-balancing means the debit side or the left-hand side must be the same as what? The credit side or the right-hand side. That's a self-balancing. So it must balance automatically. Why? Because this one says that capital reduction. It means that the maximum loss has been claimed from the books. However, in some situation, a good scheme, it must balance before the scheme will be good. Second, if the scheme is super good, it will balance and give a positive answer. So sometimes the credit side or the gains will be more than the losses. That is what you are looking for. It means that at the end of the day, you're able to clear the losses and even create additional surplus for yourself. That's the interpretation. So take note. If you balance, it's not balancing. Then the gains must be what? More than. So therefore, the difference come here as what? Capital surplus. It means that in the new balance sheet, this capital surplus will go there under the ordinary share capital, not the equity. You take it there. Good. Now take note that if here the losses are rather more than the gains, that one is a disaster. It's like a tsunami. Yes. We wanted to solve an issue, but rather you've worse it. It means that you are not able to clean the losses. You have rather what? Create additional losses. You're not able to even create it. You have what? Create additional losses. So that is the game. So that's how we create the capital reduction account. Look at how we solve the second question that we will pick. We will pick two questions in here and there with it. Great. Now let's move on to the next account that you have to open if you are designing, no, if you are preparing financial position. This is the first account, capital reduction. Account number 2, stated capital. Number 2, stated capital. Stated capital. Stated capital. Now, stated capital is made up of two items. Stated capital is made up of two items. One, ordinary share account. So ordinary share capital account like this. And preference shares. Preference shares account like this. So these are the two accounts involved. And these are the two items that make the stated capital. So the stated capital, we need to go by this and then you are done. Great. So that is the item number 2 that we have to open. Here, any increase, bring it to the increasing side. When the shares are increasing, bring it here, increasing. And here is reducing, bring it here. So anytime ordinary shares are increasing, then we bring it to where? Here. Because definitely we ask them to come and buy new shares. Yes, so that we can use that one to raise money. Come and buy new shares so that you can use that one to raise money. So that's why we pay subscription annually, so that the institution will use to raise money. That's why we have to register the paper. Anytime you can register the paper so that the institution will use to raise money. So it's not like buying shares for selling the shares sake. Yes, to raise what? Money. To raise finance. Good. So that is it. So anytime they are increasing the shares, bring it here. Anytime they are reducing sacrifices, all sacrifices will come here. So if you have informed or you've begged one of the shareholders to sacrifice maybe a portion of their shares, all the sacrifice must be here, which is a gain to the company, which moves to the other hand as a positive here. Perfect. Okay, we are done with the account number 2. Let's go to the third account that you need to open before you can prepare the balance sheet when they give you a scheme. Okay, please can I take off the capital reduction account? This one, can I? Great. So now let's continue the game. So let's look at the third account that you need to open before you prepare the financial position. Account number 3 is you have to open bank account. Bank account. With the preference shares account, it takes the same as the ordinary shares. So that one too, increasing comes here, reduction comes here. If you are transferring some amount from the preference shares, send it to the debit side. So here is decreasing. It's about transfers, reduction, cancellation of shares, and here is about increase of the preference shares. And here too, it is likely that the preference shares should be cancelled at the end of the day. So check. Why are you canceling preference shares? Preference shares too, they also requires fixed dividend. Fixed dividend. That's what we call them preference shares. They take preferential liability or preferential stand. So we are struggling. We can't be paying things consistently. When COVID came, all consistent payment was released. Even filing for tax in most countries, the date were extended. So if we are really struggling, making payment consistently, it's very difficult. So if you are struggling, all items that demand regular payment must be cancelled. One of them is preferences. Preferences, whether you make profit or not, they come and take their dividend. It's fixed. Like interest. Whether you make profit or not, you have to pay the interest on your loan facility. Unless you negotiated well with your bankers for them to freeze the interest, even up to certain level, they can't freeze for all. So to be on safer side, make sure that you cancel all those items, not in bad situation. Cancel them in a bad situation so that you have your peace. Even if you are not owing anybody or you're not paying something regularly and you don't have money, you know. You can manage yourself very well. You can manage the affairs of the business very well. But if anytime you have to make money, things are not well, you are still making payments. So take note of that. Let's come to bank account. Now, with the bank account, we are revitalizing the business. So I told that we are fertilizing the business very well. By all means, we are going to make payments, and by all means, you are going to receive money. So the receipt and payment, you have to pass through our bank. So you know the closing bank balance after the reduction. So we may require some of the ordinary shareholders to bring additional money in the form of buying shares, and may also pay some of our liability. Yes, some of the debt holders, they may not agree. At the date that we are preparing the scheme, they're on their neck, giving us warning, send us letters that our amount is overdue. So we should come and pay it. And we tell them, don't worry. We are doing reconstruction. Whatever we get from it, we hear from us. At least we come and make ourselves good. So you pay. So that means some of the onerous debt must be paid, including reconstruction expenses. So here it's like this. You bring the open balance. Good. And then you put the open balance in. Now, the bank, if it's among the assets, all assets have a what? Debit balance. So bring the open balance here. Yes. If you are not familiar with debit and credit, if debit and credit is not too familiar, let's look at this. How this one you remember, right? Asset is equal to equity plus liability. Good. All these items, if you pick them from the balance sheet, they have a credit balance. Send them to the right side. Send them to the right side over here. Then if you pick any items under assets, that was side, left side, send them to that of the debit side or the left hand side. Good. So that is it. So for debit and credit, once we ban it in our class. Okay, so that is it. Now, after bringing the opening balance in the books, maybe
It's only the fund.
in fact for the open balances, it move around all the figures. If you pick any item, any account that you want to work with, for instance, bank or ordinary share capital like this, and want to work with it, first, for the purpose of sixth generation, record the open balance first. But sometimes this debit and credit, normally, most of us are not accounting gurus. So debit and credit is of issue. So here we are saying that don't worry. Asset is equal to equity plus liability. So check whether the item that you pick is at this is a equal to sign. Is that the right side or left side? It's at the right side, right? Good. So that means you have to also record it here. So check whether the ordinary share capital that you have picked is in equity, within the equity or liability. So we bring the balance here. The item that you have picked, check. If you within asset, then that means the balance must come here. So that is it. So bank, if it's among assets, that is a good balance. So the balance, will come here. Good. So as balance will go down. Sometimes so you be in overdrafts. or credit position with the bank. So therefore, that one comes here. Good. Because that one, at that time, you pick it from the liability. Any figure picked from here, the open balance must be here. Any figure picked from the liability section or equity section, if I even they call it bank and it's at the liability section, they are owing, so it's a liability. So you record it here as open balance. Good. And then that is it. And then, however, if you know that this item have a debit balance, and that item increases, you have to debit it. So increase it at where the open balance is and reduce it at the opposite side. So if that item increases, you know that bank have a debit balance or is at what side? The left side. When it increases, go and top it up at what? The right side. When it increases, go and top it up. So increase, go and top it up. Increase, go and top it up. But when it reduces, decrease, send it to the opposite side to reduce it. Good. So that is very important when it comes to the ordinary and preference shares. When ordinary shares are increasing, they are here because they have a right balance. Good. So very soon we will introduce what we call right balance and what left balance to replace the credit and debit balance. Good. So if you have a credit balance, it increases here. If you want to reduce it, send it to the opposite side. It will reduce it for you. Yes. This topic is purely double entry. Yes. Cancel increasing double entry. Crediting, debiting. Then you are done. Okay. So basically, that is it. So yeah, then. Now, at the end of the day, you balance the bank account, send to the new balance sheet. Then items number 4, maybe debenture account or the debt. They may ask you to convert some of the debt or convert or reduce the interest. So either we have to convert the debt to what? Ordinary shares. So debenture 2, bonus, it's part of the liability. So the open balance will come here. Then you start your adjustment. Then you are done. Good. So let's take notes of that. Okay, so when you are done, you balance all the accounts. If any of them balance,
So now the open balance brought down.
good. So balance brought down as the open balance. And then any other adjustment you need to do, you do it in there.
So
If the debt is increasing, so come here, bring it here. If they are cancel part of this debt, it will come to the opposite side, so reduce it. But if they are cancel, it will reduce. If they are transferring part of this debt to somewhere, it must still come here because it will reduce. Transfer, reduction, all must come to the opposite side. And then you are done. Good. Now, when you are done with all these accounts, you balance them. Some of them will balance, especially preference shares to balance. And in some extreme cases, the venture two must move from the system, so they also balance. And then those that will balance, they don't need to appear on the new balance sheet. Those that will balance, they don't need to what? Appear. Because we say balance sheet is a sheet that contains list of balances arranged in order. That is all. Balance sheet or financial position is just a sheet that contains a list of balances. So if the thing has balance, there's no balancing figure. So take note. We are done. Now let's back with the what? With the last issue. Good. Yes, if it's balanced, it will not go to the financial position. If any of the item balances, that it has been cancelled off, it will not go to the financial position. A clear examples are preference shares. We don't like them at all. Those preference share people, just move from the system. Because they are entitled to dividend every year, whether we have money or not. When we are struggling, they've not seen it at all, that things are not well. So they should give us some break. No. So that's why those people, we have to cancel them from the system. Let them go. They'll come and worry us when things are not good, because now we are now beginning to pick up small. If you pick up small, you are making payment to these people That means you're working for them. Oh. Whatever you get, they're going to take it away and may end up getting you back to your original position. So wait, when things are good, you call them that, hello guys, now things are good. Come around. Let's chop the money. Come around. So they also come. Okay, good. So that is it. Great. So now let's continue the game. We are going to pick our first illustration question called Arjun Limited. So our first illustration question, let's take it from Arjun Limited. Please solve it as we are going to do in the event that they appear. I call this question the second coming of this question. The one I'm going to solve these two questions. Second coming of the questions. Second coming. Probably you might not understand this, but after the exams, so what were you talking about the second coming? Yes, I'll explain after the exam. What I mean by second coming. Second coming. Okay. Great. So we pick a question called Adjunijuni Limited. Adjunijuni. Thinking limited. No, what thinking to is not allowed in the exam. So Adjunijuni Limited. Let's go to the question. It's the question that I think I projected or I sent onto the group. If you don't have it, can you let me know? If you don't have the Arjunijuni Limited, can you let me know so that I'll forward it to you? Arjunijuni Limited. It's also in the mock question. Yeah, mock question 1. If you do have the mock question hard copy, you can also open mock question 1. So I'll even open it from the mock question 1. The mock question 1 is the same question, which is in the intervention kit. So I will project all of them. Make sure that you have a copy of all of them. So Adrenaline Limited. Compulsory question 1A. I'll go straight to the requirements as usual to avoid deviation. Please, how we solve this question? That's what we expect you to do in exams. Yes. And don't forget the game of hunting for marks. Hunt a lot of marks for me. Hunt them. Let's go to the requirement. You are required to prepare a balance sheet as at 1st January 2018 after reconstruction has been affected, showing detailed workings. What are the workings? 1, capital reduction. 2, stated capital. 3, bank account. 4, debenture. You are done. Number 2, to prepare computation to show the effect of the proposed reconstruction scheme on the ordinary shareholders. So here we are just looking for the effect on the stated capital. Good. So let's take the requirement again. So you are required to prepare balance sheet as at 1st January 2018 after the reconstruction scheme has been what? Affected, showing detailed workings. 2, prepare computation to show the effect of the proposed reconstruction scheme on the ordinary shareholders. Okay. So let's quickly. Right after the requirement, set the tone. Right after the requirement, set the tone. Let's answer this your answer booklet. page 1, page 2. What do you have to do? I'll start. Adjunini Limited. Adjunini Limited. Adjunini Limited, right? Or Adjunini Limited. Like this. They say balance sheet. There's not say balance sheet. Don't write statement of financial position. No. Say balance sheet. So I say balance sheet. But in the modern section, I wrote statement of financial position. But we have to tell me statement. How to call it balance sheet because the examiner said balance sheet. As at 1st January 2018. Or if you think quoting of the date will be an issue, sometimes you cannot determine the date. Don't worry, don't quote the date. Tell the examiner that balance sheet just after the scheme. Balance sheet just after what? The scheme. Good. Your currency. Check whether they phrase 3 zeros in the question. Yes. When I check mine here, they phrase what 3 zeros. Good. You hold the question like this. Your pen is on one side. 3 zeros. Yes. Then put it down. 3 zeros. Great. Then the B, the workings. So number 2 is the B or 2. So we should do what? Capital reduction. 2, we should do ordinary share account. So ordinary share account. So any other account that you need aside this must be a workings for you. These are requirements. So we must see this one clearly. We don't need to suffer before we can see this requirement too. Don't come and put the workings first and the actual one that we want at the back. If you're writing a report, I believe strongly that you write the main report first before the appendix. Your workings before your diagrams comes back. So I'm begging you, let's follow the same format here. Okay. Now let's start again. As usual, you start with the footnote and you open your capital reduction account. Your capital reduction account. The balance sheet capital reduction. So let's go to the footnote one after the other. Like the footnote start on top. Of the financial statement. So Argentina Limited is a company that carries on business as a fruit juice processor. For the past few years, it has been making losses due to a stiff competition. The company's balance sheet as at 31st December 2017 was as follows. The balance sheet is there. Let's move on to the footnote. The company has changed its marketing strategy and is now aiming at high-end hotels and door-to-door services, to corporate office. Yes. And this statement is the same thing in ironing, door-to-door service. Okay. Management believes that with this new strategy, there is a glimpse of light at the end of the tunnel for the company. Good. So that this scheme, before they can accept the scheme must what? Turn the company around. It shouldn't come and mess up things. No. Before they can accept any scheme, the scheme must what? Turn around the company. It must revive the company before we can accept it. And that's what they are telling us, that in fact, with this new scheme, in fact, there's a light always at the end of the tunnel. We can see some small light. Yes. So let's go. Good. So note 1. No, not note 1. The directors are proposing to reorganize the company and have produced the following proposals for discussion. So that's the scheme that they've designed for you already. You have to base on it. They'll number it one after the other. First, cancel the existing ordinary shares. To cancel the existing ordinary shares, let's go and cancel it. Cancel what? Existing. Are you going to cancel all or part? So they say cancel the existing ordinary share. So that means cancel what? All. They didn't say part, so it's all. Cancel all. So let's go. What is the ordinary share? Let's go to the balance sheet. The balance sheet, ordinary share is what? Ordinary share capital is 10,000, right? Yes, it's 10,000 from the balance sheet. So let's go and cancel ordinary share capital. So when we cancel, will the company gain? Yes, I mean we gain because we are cancel certain investment from the shareholders. So let's go and do the cancellation. So first, I need to open ordinary share capital account nicely like this. Second, I need to open capital reduction account. So let's assume that this is my, in fact, let me do the opposite. This is my capital reduction account. Capital reduction account. All gains, all losses are here. All gains are here. Don't need to write them all. No, don't write them. I don't know, the examiner will know where you're coming from. The examiner will know where you are coming from. Don't write it. Yes, they'll know where you're coming from. Don't write it. Yeah, so this one will be the workings because this is the main solution. This one is the main solution. So after this account, leave enough space and write the workings because this one is the workings. This is the first requirement, second requirement. Any item that you need is workings. So whether they ask you or not, capital reduction must be part of your workings. Here they didn't ask. That doesn't mean you are not going to do it. So it must be part of the workings. Good. So workings number one is what? Capital reduction account.
This one is not part of it.
This one is not part of the workings. It's part of the requirement. That was the second requirement. So that we should show the effect on ordinary share capital. That was the number two requirement. The second requirement.
Proposed reconstruction scheme and the
Okay. So first, this is the capital reduction account. It's a self-balancing account. So they say we should cancel all ordinary shares. Ordinary shares, the balance is what? 10,000, right? So open ordinary share account. As usual, where would the balance go? Here, right? At the right side because of the equation. Asset is equal to equity plus liability. So equity is here, right? Good. So balance brought down 10,000. Now they say we should cancel. And we said that if you want to cancel something, send it to the opposite side of that account to cancel nicely for you. Great. So therefore, we will send it at the opposite side and write in the name of what? Capital reduction account, 10,000. Then it will go to what? The gain side of the capital reduction because the company will gain.
because we are cancelling.
Good.
We are
We are reducing the ordinary share capital. But we are reducing all the figure, cancel everything. So we send the opposite side to cancel. So that it will be a gain. So right here, ordinary share capital, 10,000 here. So if we should end here, then ordinary share capital will no longer exist. Then we continue the game. So let's continue the game. Now let's go to the second one. No, two. To redeem the current 12% debentures, not debentures, 12% debentures in exchange for one 2.925 million 10% debenture redeemable in 2040. Now this 12% debenture, we are redeeming it. We are paying back or converting it. How? We said that first, part of it should be converted to 10%. Why are we doing that? Because the 12% is too high. We are struggling. The interest is too high. So let's convert part to a smaller interest and ask them to increase the repayment date to 2040. If you check the balance sheet, the original one, the repayment date is what? Let's go to the balance sheet. It's 2025. 2025, we are in 2018. Left is just 7 years for us to redeem that debenture. And 7 years is too short for us. We are struggling. We don't know whether in 70-year time we can make those money available. But we are able to push for the 2040. 2040 is like 20 years ahead of us, which is very good. But 20 years ahead of us, which is very good for us to take our time and make some good money and then use it to pay them later. So that is the assumption. Good. So first, in short, what do you do this? You first of all, we say we are converting, so you have to move it from the 12% account to where? To the 10% account. So open the two debentures. So let's open the existing debenture account. So the debenture, I'll do that one here. So I'll come back and then when I do the balance sheets. But you don't need to do it though, because I don't have space. You can continue here. You will continue with your workings and open the accounts there. But I will continue here. So first, 12% debenture. 12% debenture.
But to be on the safer side, how many spaces do you think?
On the balance sheet, for balance sheet, this person first page is okay.
No, I mean,
Capital reduction. Capital reduction normally contains a lot and then the ordinary share capital. So on average, I think like 10 each. It's okay. Okay, so 12% debenture. Let's open the account. Immediately write the balance. Let's go and pick the balance. 12% debenture. What's the balance? I have mine here. The balance is 3,800. So balance, open balance. So I write it here. Balance go down 3,800. Then second, let's say we should move part to 10% debenture. So I'll move it. So by moving it, same to what? The opposite side. So we are moving to where 10% debenture. How much are we moving? We are moving 2,925. The figures are in thousands, so don't forget that they are in thousands. So that is it. Then we immediately open what? 10% debenture account and place it in. So 10% debenture account, it will be like this. Just that for that one, there's no open balance. It's new. 10% debenture is new. There's no open balance. We can't get on the balance sheet. It's only the 12% debenture which is on the balance sheet. We are just converting part of the debenture to a lower interest. Because 12% is too high. We are struggling. We are saying we should pay interest 12%. So we record it here. It's coming from 12% debentures, and the figure would be what? 2,925. Here's 1,000. We are done. Let's go to the second part. The second part says that 3,500 ordinary shares of 250 each, fully paid. Wow. So we are redeeming it. We are canceling. We are paying. We are transferring some of their funds. So here we are giving them what? 3,500 ordinary shares to reduce how much we owe them. Yes, we are converting that to equity. But each of them, the value must be what? 250 cedis. So what will be the value? What will be the amount that we are going to give it to them? So multiply 3,500 by 250. Great. So if you multiply 3,500 by the 250, we are paying that debt with what? With ordinary share capital. That's 800 and what? 75,000. Perfect. So that means it must be moved from the same account to where? Ordinary share account, because we are paying or we are redeeming it with shares. We owe you. We're supposed to give you money, but because we are struggling, we find it difficult to generate cash. So we can easily give you shares to cater for the amount we are owing you. So here, right? Ordinary shares. All these shares. Good. And open a bracket. Tell the examiner that we are giving them 3,500 shares times 250. Don't forget that we're raising 3 zeros on top. So left it was 875. Immediately, I'll go to ordinary share capital account and then I'll go and then bring it there because it will increase the ordinary share capital. So let's go and record it there. Please do not finish it before you look for where to go, the other corresponding to go. Go and do it before. If you do one leg and leave the other leg, it will not balance. When you are preparing the balance sheet, rather you are looking for the where the other balances will go. No, you can't remember. So come here and come and put it here. So right here, 12% debenture, and the value is what? 875. I'm done with this. Try and balance this and see whether it will balance. As soon as it's balanced, that means they vanish from the book. In a new business or a new balance sheet, no 12% debenture. Instead, we have what? 10% debenture. But their value is what? 2925. Perfect. Wow, it will balance, eh? Let's see if it will balance. Let's see if it will balance. So here's 3,800. And then, yes, so 3,800 and 3,800. So it means that in the new balance sheet, no what? No 12% debenture. Okay. Now let's continue the note. Note 3. Note 3. Please, as usual, when reading the note, don't try to tackle one note fully. Want to understand the note fully? No, understand it bit by bit by bit. Because that question didn't tell it a whole. In fact, word by word, each letter by letter. None of the letters were like manufactured, boom, and there. So the same way you cannot solve it like boom and put the answer there. No, you start small, small, small entry. One, one, one. By the time you realize you are done with the game. But I say you should understand everything before you start. You won't. So look at how you're going to do the note 3. It's a bit lengthy and packed. So you take them line by line. If you see end, make sure that you understand what before the end. Before you go to what? The after. End. That means you are joining two things together. And do this. And the remaining will be paid later. Do this and remainder will be this. So do the first one first before you go and look for the end. If you see full stop, please stop. If you see comma, relax a while and come back. Good. So let's start the game. Look how you're going to do it. Note 3. To cancel 32% of 9% cumulative preference shares. And no, I'll stop. There's end there, so I'll stop. I have to do this one first because this one's so simple. To cancel 32% of 9% cumulative preference shares capital. So I have to cancel 32% of the 9% cumulative preference shares. So in short, they say cancel 32% of the preference shares. Go to the financial position or the balance sheet as they call it. What is the 9% cumulative preference shares? The value is 2,500. They say cancel what? 35. So let's go into that one first. Don't even continue. If you don't understand the first one, try and do that one before. Yes, 32%. So find 32% of what? 2,500, and that's what you're going to cancel. So let's go to the board. So you open preference shares account. Yeah, I'll clean the debenture because it has balance. So I want to clean this side and then do it there. And do preference shares there. They say we should cancel 32%. So I write here preference shares. So preference shares. With the preference shares, immediately bring the balance. The balance brought down.
Is it just preferences or 9% related?
You can write 9% cumulative preference shares, but if you write preference shares, it's also correct. For this question, you have only one preference shares. So to avoid bringing a lot of writing, making it fast. For this one, it's only one preference shares. Okay. So let's see. So the open balance is 2,500, and then your three zeros on top. Don't forget. They say we should cancel 32%. So what if you cancel? Where are you going to send it to? Where are we sending it to if you cancel? Yes, you are cancel 32% of this value. Where are we sending the cancellation to? Good. So we have to look for the cancellation first. We say we should cancel 32% of the preferences. This is the preferences, 2,500. We should cancel 32%. Why are you going to send it to? Is it a gain to the company or is it a loss? If you cancel preferences, it's a gain. So it must come where? Here, and at the same time, reduce it here. So we are going to cancel. So it must move to capital reduction. So capital reduction account. Open your bracket. Tell the examiner that is 32% of 2,500. Whatever answer you get, you put it in. And this answer will be, if you do the calculation, you get 800. So that means 800 must be what? Cancelled. So we send it to capital reduction account as a gain. So let's come and then record it here. It's coming from preference shares. So record preference shares here. So let's record preference shares here. 800. So what you've done so far is just the cancellation. What we have done so far is just what? The cancellation. Good. So cancel means bring it at the opposite side of that account, send it to capital reduction account as a gain or loss, but here it's a gain. You are done. Now, then you come back again and come and then look for the next line. Obviously, we are not doing all together. Oh. Do it one after the other. Yes. So let's continue to one after the other. So we are here to cancel 32% of the 9% cumulative preference shares capital. We've done that. We have canceled the 32%. And convert the remainder into ordinary shares. Full stop. I'll stop. I can't do it. They say I should convert the remainder. How do I get the remainder? The thing is 2,005. I've canceled 800. Now the remainder must go to ordinary share. So what's the remainder? What should I add to 800 so I can get 2,005? The remainder must go to where? Ordinary shares. So I'll write here ordinary share capital. 1,007. Then I'll go to ordinary shares account. And then I'll record it here as what? Preferred shares. So ordinary share, why are you? Ordinary share capital. Ordinary share capital. In fact, here, this is the capital reduction. Good, this is ordinary share capital. But this figure must go to capital reduction. We got it in this one. So let's push it here. It was the cancellation. We canceled 32%. It must be in this account instead. The capital reduction account. The 800 must go to capital reduction, not the ordinary share capital. How we get? So This 800 that we cancel, we say capital reduction. So the corresponding entry must go to capital reduction. So moving it, I thought it's the one that's on top, so that's why I wrote it on top. But now it's different to this. So now ordinary share rather is here, right? So we are canceling the remainder 1,007. So right here, preference shares. So this will rather preference shares rather 1,007. That's all. You balance this, you balance. That means that's moved. So 2,500. 2,500. That means in the new balance sheet, we don't need to record what preference shares that's cancelled from the system. Why? Because that's balance. That's moved from the system. Great. So that is it. Okay. So let's see. Now let's continue the same note too. And listen, small. I said we did not type the question at a go. Or manufactured. Boom, the question was in. All the notes assembled. One after the other. So the same way when I'm solving it, you solve them one after the other. You read line by line, note by note. Those that you can do, as usual you do. Those that you cannot do, what do? You hunt for marks. And the next line or the next sentence. So that note alone, it have a lot of stuff. In which if you are going to do them together at a go, no, to confuse us. So line by line. Additionally, the 9% cumulative preference shareholders to be issued with 2,000 ordinary shares of 250 each in settlement of 4 years arrears of dividend. So that's the latter part. So it means that we owe them 4 years dividend and we have to pay or we have to settle. Good. We have to pay or we have to settle. So what we have to do is this. First of all, we have to get the total value of the amount that we are paying them. We are giving them 2,000 shares. Each of them worth 250 Ghana. So when you multiply, what do you get? So 2,000 by 250. That will give us 500,000, right? So we are paying them 500,000 to settle all the dividend in arrears. Good. Yeah, I'll give you a shortcut approach. Then we go by the long way too. So let's see. Anytime you are paying preference dividend in arrears, how do you go by it? Please, that particular section, almost every question you see there. Okay. Okay, so what you do is this. First, there are 3 steps. Step 1, get the value of how much you are giving them. So here it's what? 500,000. Step 2, record it in the ordinary share capital account because you are paying them with what? With shares. Anytime you are settling dividend in arrears with shares, it's common that the dividend in arrears you are going to pay with what? With shares. So you can't get money to come and pay you. So we are going to pay with shares. So step 1, get the value of the shares that you are giving them. You understand we are giving them what? 2,000 ordinary shares. Each of them worth 250 Ghana cedis. So therefore, the entire 2,000 shares will be valued at what? 500,000 cedis. That's the first thing you have to do. Step 2, we are giving them shares. Would our share capital increase or decrease? It will increase. Good. So go to share capital. Where are you? Share capital is here. And record it there immediately. Record it as preference dividend in arrears. So preference dividend in arrears because we are issuing shares to pay a dividend. So our share capital must increase. Instead, if you want to increase it, send it to the balance. So you open a bracket, you do the workings there. Open a bracket, kindly show the workings for something minus something or something times something. So here will be 500. So I'll just have to record 500. Let me see if I can provide some small working solution. So into bracket 2000 times 250, that will be 500. Then that's the step 2. So step 1, get a value. Step 2, record it in what? Ordinary share capital. Step 3, let's say again to us was the loss. Dividend I suppose we didn't pay last 4 years dividend, and today I want to pay it. So that means it's a loss to you. Yes, so that dividend that you are paying, it's a loss to you. So add the loss side of the capital reduction account. This capital reduction. So I'll come here and come and write what? Preference dividend in arrears, 500. We are done. So that's a 3-step approach. Okay. So basically, that is what we will do. It ends there. That's all. I don't give the long approach. The long approach is that find the total dividend, which is in arrears, 4 years, right? And the dividend is preference dividend is 9% cumulative dividend. Cumulative shares. So it will be 9% times the value, which is 2,500. And that will give us 14. No, not 14 now. 9% times this. That will give us 225 times 4 years, because in 4 years arrears. This one will give us 900,000. So the dividend, which is in arrears, is 900,000 for 4 years dividend. So the long approach is this. First of all, the entire 900 is owing. So that 900 must be part of the capital reduction. We write 900 here. Capital, that's the long approach. Then, second, you are getting low. How can you pay something which costs 900 with what? 500 Ghana? So you're owing by what? 400. Like you are gaining. It's a gain. So bring it here. 400 as a gain. So let's let off 400 against 900. The difference is what? 500, which is will be here, right? Perfect. So that is the how we will look at it. Good. So that's the long approach. But let's go by our shortcut approach. First, get the value of the shares you are given. 2, add it to your shares. 3, your loss at the capital reduction side. What if this time around you are not paying shares? You are paying what? Cash, fiscal cash. What do? If you are paying fiscal cash, that one you will subtract it from your cash balance. It's not going to share capital.
So it's not the second one, add it to your case.
The second point, the third point, add it to the capital reduction account, the loss side. The loss side of capital reduction. Why is there loss? Because for the 4 years, supposed to pay something, not pay, and today you are going to pay it. So that's why I say it's a loss to you. So step 1, get a value. Step 2, add it to the ordinary share capital. Step 3, add it to the capital reduction, the loss side. So this is step 3. Add capital reduction, the loss side, the loss. Good. Add it to the capital reduction, the loss side. Why is it a loss? The loss because something that's supposed to pay 4 years or supposed to pay, they are now paying it. So like the loss. We are done. Now let's move on to the next note. So I've seen that even though that note is a bit plenty, we've taken our time and like break it down sentence by sentence. I always say that we can't do all together. So line by line, we are done. Let's go to note 4. Note 4 says that the existing so note 4 says that the existing ordinary shareholders will be issued with 3,500 ordinary shares of 250 each, for which they should pay in cash. Great. Okay, so to solve this, first we multiply the 3,000 ordinary shares by 250. Then we get 875,000. What is the treatment? They are issuing new shares. So as usual, the share capital will increase. So send it to the increasing side of the share capital. We said that if the shares are increasing, send it to where? The shares are increasing. What share capital here? So they are increasing. Now send them here. In the name of what? Cash or bank. Because you are receiving cash or bank. So the name of cash or bank. Show your workings in here and write the 875 here. Because to increase. Second, go to the bank account and increase it there. Just that in this question, we don't have bank account. So let's go to that financial position and see what we have there. We do have. There's nothing like cash account. We have cash account that it will go in there. But in this question, they've total all the current asset for us as what? They've total it. So we can't pick it. So we have to wait. When we go to the balance sheet and we add what? The 875 to it. Good. But they've given us current asset. And we know that cash is inside current asset. Bank is inside current asset. So in the new balance sheet, if you pick that current asset, then you add 875 to it. You are done. You add what? 875 to it. Then you are done. Okay. So that means the other corresponding entry, we do it on the face, but we don't have the specific account that will affect. Because current asset include what? Inventory, receivable, cash. We cannot go and then bring the open balance and then do the changes. So we do it on the face. So that's it. So we are done. Then we move on to the next one. The next note says that to reduce, so to revalue, reduce the non-current asset by 500 and 300 for irrecoverable, receivable, and inventory written down respectively. Good. So we are going to reduce the non-current asset. I'm just making changes here. To revalue, we said that in capital reduction, there must revalue. We are doing note 5. Okay, so here we said that to revalue, reduce the non-current asset. Yes, I want to make it non-current asset. Reduce the non-current asset by 500,000 and 300,000 for current asset in respect of irrecoverable, receivables, and inventory written down respectively. So they did a revaluation of the non-current asset, then it was reduced by 500. So you go, that means in the new balance sheet, we need the revalued amount. The revalued amount is what we pick towards the balance sheet. So let's go to capital reduction. To reduce, reduction means it's a loss to us, right? So I'll go to capital reduction account and then record non-current assets. I am reducing it by 500, so it's a loss to the company. Current asset, I'm also reducing it by what? 300. So it's a loss to the company. Then you are done. Then let's move on with the notes. The next note stated that in the event of liquidation, it is estimated that the net reserve values would be, no, we don't need net reserve values. We don't need NRVs. We need to revalue the amount, and we've done that. So it ends there. You don't need to touch them. You call them a trap. Good. Okay, so that's the end of the game. And then immediately check the income surplus. It must be written off. Whether the examiner informed you or not, write it off. Income surplus must be what? Written off. So let's go to the face and go and pick the income surplus and write it off. It's a must. Write off the income surplus, whether they inform you or not. A good examiner will tell you that the income surplus must be written off. So it's 9,500, right? So it's a loss to the company. So let's go and then treat it as loss. So go to capital reduction account and write it here at the loss side. So income surplus. Income surplus. 9,500. You are done. So we are done with that of the everything. So balance the account nicely. So balance the account nicely. Then post the balance. So balance all. So now we take our time and balance all. The preference shares is balanced, so they are gone from the system. 12% debenture is also balanced. As soon as balanced, don't send them to the new balance sheet again. That's balanced. Now we said that ordinary shares to balance it. The new balance sheet figure sent to the balance sheet. So let's balance the ordinary share. How do you balance the ordinary share account? We balance it. Just underline it. Double. Like this. Ordinary share capital always this will be more than this. So sum all the one at the credit side up. So let's do it together. 10,000 plus 875 plus 1,007 plus 500. This is 500 plus 875. And that will give us 10,950. Then 13,950. So it should be 13,950. Then what should I add to 10,000 so that I can get this answer, the balancing figure? So bring it as well. Balance carry down. 3950. The 500 was the preference dividend. We had 500. We gave them 2,000 shares, valued at 250. Good. There's preference shares and preference dividend. There are two things altogether. One is dividend, one is shares. Good. So therefore, we put them together to get a balancing figure. Then what do we do? Then next, it was 2,000 times 250. Good. So in the new balance sheet, if you want ordinary share, it's 3950. That's the new balance sheet. So let's prepare the new balance sheet here. I'll do it here, the new balance sheet. Good. So we are going to prepare the statement of financial position, the balance sheet. Now, there are two things here. If when you are entering the examination room or the examination environment, especially the room, your format that you know has moved from you. It has vanished. But the format that we know is all asset one side must be equal to equity plus the liabilities. If this format has vanished from you before you enter the exams, then you have no choice than to follow the format stated in the question. The question will bring a format, follow it, or just flip through the question. If you see any balance sheet elsewhere, follow that format. But don't select those figures. Select the new figures. That's all. Okay, so let's see. The balance carry down. That is what we do. Okay, so now let's balance all the accounts. Then we move on to the balance sheet. Now, with the capital reduction account, let's see whether it's a balance. It must be a self-balance account. So this 10,000 plus 800, making 10,800. This is 5 plus 5,000 plus 3,300 plus 9,500, 10,800. It has balance. That means our financial position to balance. That means they were able to clean the losses, just the losses, but a very perfect and very good scheme. It even clean the losses and we give us surplus. So that one, this side is more than this. The next question that we will pick, you see something like that in. The scheme will be very good to the extent that just clear all the losses and give us good balance. But here it only clear the losses. A bad scheme rather bring more loss to us. So if this side is more than this side, that means there's additional losses after the scheme, which is very bad. Which is very bad. It has rather always the case. So that is it. Now let's get the financial position. So I'll pick the capital balance of 3950. So I'll do it here. This side, there's a reflection there, so you can let it here. This side is a bit of it. Okay. So first, Argentine Limited, the name of the company, Argentine Limited. So balance sheet. As at 1st January 2018. Don't forget your currency in thousand. Wow, down to there's another reflection there. Wow, everywhere. There's another reflection. 3 zeros is here. But let's start. Non-current asset. Here, non-current asset. The non-current asset, let's go to the question. For the non-current asset, if you pick the question, it's 3,800, and we have reduced it by 500 from the last footnote. Three values. The non-current asset must be reduced by 500. So on the face, the non-current asset over there is what? It's 3,800, and we have reduced it by 500. So let me do what? 3,300. So that's the first thing that I'll do. I'll do that working on the face that 3,800 minus 500. So for now, I'll get 3,300. I'll put it in like this. So that there's flashing here. So no, I exactly. That's okay. And again. Okay, then go to current assets. Here, no demarcation. Current assets, you open a bracket. What's their position? Let's go and pick the current asset from the book. The current asset is 5,500. If the current asset is 5,500 plus, they are bringing some cash view. The bank account, we sold some shares for cash. We had 875,000. The shares that we issued to the existing ordinary shares at the 3,500 by 250. We had 87,000. So we have to add it to our current asset. Why? Because the current asset includes the bank balance or the cash balance. Then we less the revaluation that we did. The revaluation was 300. So whatever remains, that's the new current asset. Now, so let's do it elementary. 5,500. 800 minus 300. Let it 500. 500 plus 5,500. That's 6,000 plus 75. So 6,075. Yeah, done. Okay. To put the two together, we have 3,300 here. Up you can see, oh, something's coming here. Oh, it's not coming. Oh, good. 3,300. So the 3,300 plus the 6,075. So putting these two together, we get what? Total asset of total asset of 9,375. That's the total asset. Right here, total asset. Please, kindly make sure that the next question that we solve, we move one step ahead of this for you to get everything about that. Perfect. Then we go to equity. All right, ordinary share capital. What was the figure that we had for ordinary share capital? We had 3,950, agreed. The balance sheet figure 3,950. The ordinary share capital, we have 3,950, agreed or confirmed. So 3,950. Ordinary share capital 3,950. 3,950. 3,950. Then if the capital addition account is not balanced, the difference, bring it by head balance, so there's no difference. Yeah, that's ordinary share capital. Let's go to non-current liability. Under the non-current liability, who will tell us the liability left? And that person will be the accounting tracker for the night. The non-current liability left, who will tell us? Non-current liability. Particularly the 10% debenture, the one that we converted from the 12%. So 10% debenture. Good. And that is 2925. 2925. Perfect. Then finally, current liability. Current liabilities. The current liabilities do. Let's go and pick it from the face. So far, no note affected the current liability. So let's pick it. No notes affected the current liability. So let's go and pick it like that. Current liability is here. 2,500. Current liability is 2,500. So current liability is 2,005. Let's bring the 2,005. So at the end of the day, if you put all the credit one together, the amount is the same as this. So let's see if it will balance nicely for us. 9,375. Because this one, total equity and liabilities. Good. So we are done for the first half of today's edition. So we will break for now and continue again in 30 minutes time. Our break is 30 minutes time. Good. So we'll end here for now. Can you join exactly 30 minutes time for us to continue the game? Don't delay. For the question that you're going to solve after this is outbreak of this. And that one is very critical. So you don't need to, and you cannot afford to miss it. Because I call those questions second coming. And you understand why I'm saying second coming. Second coming of that. Important. Okay, so if you do have any questions like this, you can bring them before we end the chapter for the first section until we probably meet again in 30 minutes time. So kindly continue the watching. If you have not subscribed, kindly done that to us, and be grateful. Please tell a friend to tell another friend. Yes, to sign on to this program each and every year. At the end of every year, it's something that's going to be every year program. At the end of every year, there must be an intervention. So kindly tell a friend, to tell another friend, and to tell another friend. So we'll end here for now and continue again exactly 30 minutes. Please kindly join when the 30 minutes is over. Good.